Welcome to our masterclass on transfer pricing for global businesses. We're going to give it a few minutes just for more folks to trickle in, and then we'll go ahead and get started. In the meantime, if you guys could share in the chat which countries you're calling in from, that'd be helpful. Maybe we can gear some of the presentation to country-specific issues that we've encountered at Commenda. So yeah, share where you're at in chat. Toronto. So I'm actually based in New York, so pretty quick flight from here. I've actually never been to Canada, but I definitely want to go. Ottawa, nice. Toronto, so a lot of Canadians. UK as well, nice. Vancouver. Actually was in the Pacific Northwest not too long ago. My friend had a boat, and we actually could see we're basically on the edge of the border on the ocean. We could actually see the Vancouver skyline. It was actually pretty cool to see that.
Yeah.
And just a couple quick housekeeping notes too. Obviously, we have this presentation. Feel free to ask questions as we are running through the slides. Every couple of slides, we'll stop and answer your questions directly in the chat. Nova Scotia, nice. And I know we'll also probably get this question as well. All the attendees to this webinar will get a recording of the webinar after we're done here, so you could reference it back. I'll give it 20 more seconds and we'll get started. All right. So yeah, thanks everyone. We'll get started now. Thanks again for attending our masterclass on transfer pricing for global businesses. Before we jump into the next slides, just want to be super transparent with you guys up front. And I always, every time we're running these webinars or masterclasses, our marketing team likes to tell me that I should use the term masterclass, but this is also a webinar. So, whatever works. But basically, I like to make a quick deal with the audience. Before we start, we're a company that sells a lot of these services and the stuff. So I always like to make a deal with attendees and webinars and masterclasses. If you actually get real value in the next 45, 50 minutes, feel free to book a call with us after that. We can walk you through how we help with this stuff, your specific company questions. Everyone has, specific questions that only apply to their company. We can walk you through all of that. We'll share a link to a call with us for a consultation. The consultation is free. We always get the question, book a call if you are you going to charge us for it? No. We'll walk you through how we help with transfer pricing and other services. And look, if you don't think you get a lot of value from this, don't book a call. There's no hard feelings. Go enjoy your day. But as always, I want to be transparent. All of these companies, they'll say, oh, just come for, informational webinar and not really talk about the purpose of this. At the end of the day, the purpose is we're hoping that we can give you guys concrete value and you guys have confidence in that we know what we're doing and you can book a call with us. So with that, we'll get started. So who are we? So my name is Daniel Sifredo. I'm here at Commenda. So I am the head of legal. I serve as our general counsel, and I also oversee our entity management and incorporation platform. So I help businesses all over the world incorporate and manage their entities in the 70 jurisdictions that we support. Before joining Commenda, I was at Simpson, Thacher & Bartlett here in New York City. If you haven't heard of Simpson, they're a big corporate Wall Street law firm. And there I represented a lot of private equity companies and just big companies in general. In a lot of their cross-border structuring work, M&A work, capital markets work, etc. And then I'll let Shrey introduce himself.
Yep. Hey guys, nice to meet you. I am joining in from Bangalore, India, and I am the GM of transfer pricing here at Commenda. I've been at the company for around 3.5 years now. That's when we started, and just with the aim of, helping business owners or financial controllers such as yourselves do business operations in a standardized way across the world, and transfer pricing seems to be a huge part of it. So we've been doing it for a few years now, and very glad that all of you made our time to join today. Like Daniel mentioned earlier, a lot of times when we're going through these slides and explaining stuff, This is all general information. If you have any specific questions about your business or your geography, please drop it in the chat. We would be happy to take those up. And yeah, let's get started.
So this is a quick agenda of what we're going to cover today. So we're going to cover transfer pricing basics and why transfer pricing matters, transfer pricing documentation that you need to prepare to be compliant, how transfer pricing works in practice for different types of services and distribution agreements you have with subsidiaries, specific country examples and obligations you're going to have for transfer pricing in the different countries you operate in, the risks associated with transfer pricing if you do it incorrectly or if you don't do it at all, and the best practices and solution. And we'll have a Q&A section at the end where we can answer questions as well. But again, as Shrey said, feel free to drop in questions throughout the presentation. We'll stop every couple of slides to answer your questions. Transfer pricing, to be honest, a lot of the customers we talk to, they already had subsidiaries and they weren't that familiar with it. And they just think that you can just move money around subsidiaries with, very little documentation. It can get complicated pretty quickly. So happy to answer any question you guys have throughout the presentation. So we can go to the next slide. So poll, as I said before, sometimes people haven't really heard of transfer pricing. Other people are a lot more familiar with it. So would love to know if you can answer in the poll we're running right now, how familiar are transfer pricing? Are you a beginner, completely new? The intermediate, the basics, but need more clarity, or you're advanced, in which case you've handled TP documentation in the past. And just looking at the results we've gotten so far, it looks like it's pretty even split, 40% beginner, 30% intermediate, 30% advanced. And if you're a beginner, no worries. Like in my previous job as a corporate lawyer, you'd be surprised, even some of these huge companies weren't that familiar with transfer pricing. And it's always great to get started as soon as you can, because it can create a lot of headaches in the future if you're going through investor diligence or M&A diligence, or you get audited by local tax authorities in the countries you operate in. So basically, what is transfer pricing and why does it matter? So transfer pricing is the accounting method companies use to set prices for transactions between related entities in different countries. Most commonly between a parent company and its subsidiaries, or entities that a parent company controls. Most countries have mandatory transfer pricing requirements to ensure that companies aren't using subsidiary structures to avoid taxes and setting up payments as subsidiaries in a way which allows companies to avoid taxes. Basically what is at the core of transfer pricing is the arm's length principle. So related companies such as a parent and a subsidiary should charge each other the same prices that unrelated companies would charge under the same circumstances. So basically it needs to be priced so that you could argue that this is a legitimate arm's length transaction and there's nothing shady going on because the parent controls the subsidiary. And why? So the third point here is, why does this matter? So transfer pricing determines whether you can legally move money between related entities and whether tax authorities will accept those payments. So basically, you have to have your transfer pricing mechanics really well documented, because occasionally, wherever countries your subsidiaries operate in or you plan to operate in with subsidiaries, they may audit you on a random basis and they will ask you to provide transfer pricing documentation. And that documentation needs to make it very clear that all these transactions between your parent companies and your subsidiaries are actually at arm's length rates, which are consistent with longstanding transfer pricing principles across different countries. So that's really why this matters. And it's funny, I think a lot of people, if they're really beginner, if they haven't really heard of this before, they think that you can just set up a subsidiary in another country and then you can just move money around to pay employees or pay for different services or whatever. And you can just, I'll send $100,000 from this entity to this other entity in this country. I don't have to think about rates or anything like that. But that's actually not how this works, unfortunately. I wish it was. And I mean, this practice has developed because, a lot of huge multinational companies were doing a lot of shady things so that they would avoid paying taxes. Like they would price certain services their subsidiaries would offer to the parent at an extreme rate so that they could show that subsidiaries have no profits. And then all of a sudden they're reporting that they have no profits in that other country. And local tax authorities were not a fan of that. So you have to kind of document this and so it can be audit ready. Next slide. So Shrey will go into the types of transfer documentation that needs to be prepared.
Yep. So again, Daniel quickly touched upon, like what needs to happen. You need to have these entities at an arm's length, so to say. And what you need to have at the core of it is documentation. All of these are different types of documents that you need to have. Now you can see that it varies like according to the level of reporting, and foundationally, the things that you need is an intercompany agreement, a benchmark, and a local file. And I'll quickly dive into those. So these need to intercompany agreement and benchmark. These two are the fundamental things that you need even before you do your first transaction. So this is one common misconception that people have, that until you're a big company and you have a lot of money moving around, you don't really need these. But that's not true at all. Even before you spend your first dollar and like do something with it, you need to have an intercompany agreement in place. So this is just like having an agreement with an entirely different company, right? Like if Daniel's company is dealing with my company, right? And he's selling me a service, we will have an agreement between us, right? Which mentions how pricing will work, what is the amount that I'll be paying him, at what cadence, under what laws, all of that will be documented in an intercompany agreement. And now the key thing here is that when I am selling something to Daniel's unrelated company, right, there is a standard price that he'll charge me. Now that we're working with two entities that are both owned by you, they're like sister entities or parent subsidiary, whatever it is, you can choose the pricing terms, right? So what transfer pricing arm's length principle says is that you need to ensure that there is a markup or there is a percentage of money that is split between these two entities, right? And how do you decide that markup is governed by what we call a benchmark study, right? And just like it sounds, it's basically a study where we benchmark your company's markup against the other companies in that industry, in that geography, right? So I see a lot of people are joining in from Canada. What we would do is, interestingly, Canada also supports, comparing against US companies because of the similar geography. So basically, we'll take, let's say, a healthcare company that you have and compare it against all the healthcare companies in Canada and US and see how much markup they're charging. And that is what we would finalize and document in your intercompany agreement, right? An intercompany agreement is also called a policy because it's basically the posture that you're taking while doing transfer pricing, while doing business between these two entities of yours, right? And now that you have those two set up, you're free to send money from one entity to the other, just ensuring that you abide with the policy that you set up, right? And then at the time of an audit, a merger, anything like that, by the time your corporate income tax comes up, which would be, let's say, a T2 in Canada or a CT 600 in the UK, right? When this comes up, by this time, you should have what you call a local file ready. And what a local file is the documentation of everything that happened throughout the year, right? So you're documenting your financials, your transactions, if you were compliant with the policy or not, mention everything that is in the agreement and in the benchmark study. And this is what you submit to the government, right? Not the agreement, not the benchmark study. Those two are a part of the local file, but what you submit to the government during an audit or during a fundraise, something like that, would be a local file. Now
Yeah, and
take
then
this.
just to
Yeah,
so should
go ahead.
just to get more concrete on the example of Canada. So like something this a classic example of where this comes up is if you have a Canadian entity and you want to hire salespeople in the US. So and then you set up a US entity that hires those salespeople in the US. So now you have to pay those. You have to remit money from the Canadian entity to the US entity to pay those people and those salespeople in the US. So then a need for a transfer pricing setup will be triggered there. In that case, we'll run an analysis, a benchmark study of, whatever sector you're in and, how those people pay, what's like the actual like rate for salespeople in the US selling these services. And then based on that benchmark report, which we help you with and it's automated through our software, then those rates go into a transfer pricing agreement, your intercompany agreement. And then every time you remit money for those services, those sales services that you're getting provided, that the parent is being provided to from the US subsidiary, you will have to comply with those rates that you set out in your intercompany agreement. And then all those transactions you're doing to pay those salespeople in the US will go into your local file. So I just wanted to give like a really concrete example of how that would work if you're operating cross-border of Canada and the US, right?
Yeah. And another small thing on that point is that when you're doing this transfer of money, you don't have to be compliant for each and every transaction. You can choose the cadence at which you want to, ensure that you're sending the right amount of markup from one entity to the other. So you can also choose to do it annually. And so, for example, if I did not comply with my 10% markup policy and I was at 8%, at the end of the year, before I finalize my financials, I can go ahead and transfer the extra money to the other entity, and that works too. That's what we call a true up. And then taking it up a notch, a master file is for a group of entities together, right? So if you have, let's say, 5 or 6 entities across the world, when you're being audited in one particular country, this is usually your parent country, parent entity's country. You would also be asked for a master file, which is the documentation of everything that happened across your group, right? So you take a local file, which is country specific, up a notch to the entire group structure, and you talk about the ownership, you talk about how money moved between all of these entities, what is your final balance, everything, right? And similarly, country by country reporting is also for large groups with turnover over 750 million euros. And what you do with a country by country reporting is you would take the financials from each of the countries and basically go in depth. This is usually for, publicly traded companies, or again, when the turnover is big enough for us to like break it down into different countries and then report it. You can go to the next slide.
So intercompany agreement, we've already covered some of this already in Shrey's last slide. But what it is and what it sets out, it's basically a binding contract between the two related entities. It defines the scope of the goods or the services being provided. In my example, previously, it would be for sales services in the US. It sets the price and it shows like what the method is for calculating the price and the rate that it's going to be at. And there's different methods of calculating the price based on the benchmark reports that Shrey will get into. It allocates the function, risks, and assets, asset ownership between them. Something we commonly see is, my previous example was sales, but another good example for transfer pricing is IP. So sometimes the parent company holds the IP and they have subsidiaries in other countries, and the subsidiaries need to be able to use that IP to do certain services within the country. In that case, intercompany agreement, there'll be an intercompany agreement for the use of the IP, and there'll be a rate. The subsidiary pays the payment for the use of that IP. 5 sets the rights, responsibilities, and the payment terms. And as Shrey said before, this agreement needs to be in place before the first transaction occurs, ideally. And it's not just for big companies; it can be for companies of any size and scale. And yeah, those are kind of the basics of intercompany agreements. Usually, and this is a question we get to. We just had a customer who had this question because, like, usually in the corporate context for documentation and agreement preparation, people use their law firms and lawyers. In transfer pricing, is a bit interesting. There are some lawyers that may be able to do it, but this is usually handled by different accounting firms, etc. And they're based on agreements for other companies that have been in place for a while. And then you just add in the rates from your benchmark study. So usually you don't need a comprehensive legal review, mainly because what's changing or what's bespoke about these things are the benchmark rates that are based on the benchmark study. So that's a common question we get asked, is that like, do we need to bring in a law firm to review these agreements? The answer is usually no. And especially because these are our agreements within your corporate structure. So yeah, next slide.
And Daniel, quickly, I just want to give a couple of examples for these agreements, right? So, like you mentioned, distribution is one of the main agreements that we see very commonly because, again, when you're employing someone who sells on behalf of your parent entity in another country, that is distribution agreement. There's also services agreement for any kind of software services or support services. There is R&D services, and here's the fun one, right? Loans are also covered under intercompany agreements, right? So you cannot just loan out some money to your sister entity or subsidiary without an intercompany agreement. Just like the markup, the rate of interest for this loan is governed by transfer pricing policies in that case, right? Similarly, with like royalty agreements as well, like you quickly touched upon the IPs, right? In that case, if you have a royalty agreement in place, that would also come under transfer pricing.
Right. Yeah. I mean, and I think loans, it's a big one, especially because when you have parent and subsidiary structures or sister structures, there's constantly these like short-term loans that you're making for operating capital. So it's good to have all these agreements in place to make sure you're in compliance with all the transfer pricing documentation. And Maria, I saw you said that the screen is not clear. We're adjusting that now. Hopefully no one else is having that issue. So yeah, so why does this matter? There's a couple points here, and these are two main points, and I'll talk about a third point that's not on here. From a transfer pricing perspective, it backs up your policy if a tax authority asks questions. So if a tax authority comes up to you and says like, hey, we want to audit your transfer pricing structure, and it can be CB tax authorities in the US or in Canada or in the UK, et cetera, you need to be able to provide documentation that has been signed and is effective that shows that you're putting these policies in place and the transactions that you have done between the entities are actually reflecting these rates. Yes, so that's the point number two here, matches the functional analysis. It also documents who owns the key assets and IP. And it also sets out how the risk is shared between the entities. The second point here, I think is probably useful for anyone on this call, is permanent establishment risk. So this comes up, let's say you have a Canadian entity parent, and now you set up a subsidiary in India, for instance, or in the UK. You set up a subsidiary in the UK, in India. So then what permanent establishment is the local tax authorities, if you're doing business in another country through a subsidiary, they'll obviously tax that subsidiary based on the tax rates there. But you also want to protect your parent entity because occasionally a government tax authority will say, hey, this parent entity is doing a lot of business in India, for instance. We're going to label them as they have a permanent establishment. And then we'll also tax that parent entity. That is a nightmare. You do not want that. You only want the tax authorities to reach your subsidiary. If you don't have any transfer pricing documentation in place, the government tax authorities have a very strong argument to make that, hey, the parent entity as well is doing a lot of business here. It effectively controls the subsidiary. The subsidiary just does what the parent entity says it says it to do. So basically, the parent entity also has a permanent establishment in India. So therefore, we're also going to charge the parent entity, which would not be great, especially if that parent entity has a ton of profits and revenue, et cetera. So if you have transfer pricing documentation in place, then you can go to the tax authorities and say, hey, we don't have the parent entity doesn't have a permanent establishment because look at all these different arm's length rates that we have established with the subsidiary for all the different services a subsidiary is providing the parent entity for sales or IP or whatever. And they functionally operate as two distinct legal entities for tax purposes. And it's as if I had a parent entity in Canada and I was just contracting with an unrelated entity in India. So that's a much stronger argument to go to the tax authorities. You're going to have less of a strong argument if you have no transfer pricing documentation in place and you're just moving money back and forth. That's going to open you up to significant risk. The third part of this, which is not on here, is investor diligence and M&A diligence. Let's say your company is extremely successful and you want to raise capital, or you're getting bought by another entity, by another company. Usually in the reps in a merger agreement or in the representations and agreements you enter in with investors, there'll be a representation in there saying you're in compliance with all local tax laws or just all local laws in general. And then attorneys for that company that's acquiring you, attorneys for the investor that wants to invest in you will get access to all your transactions, all your documentation. And if they don't see that you have transfer pricing documentation in place, they'll say, hey, you can't honor this representation that you're in compliance with local tax laws. And it's going to create a headache for you because that's going to hold up the diligence process until you have proper documentation and policies in place for transfer pricing, because you're technically not in compliance with local laws. So that's something to think about too, because we got a lot of customers. They're like, yeah, I want to be compliant with the local tax authorities, and in some of these jurisdictions, countries, it's just like if you don't do it, you can get away with it until you get audited, and there's a huge tax penalty if you get audited. But it's not just about getting away with it until you get audited. if you don't have this stuff in place for an investment transaction or an M&A transaction, it will hold up the transaction because you're not in compliance with local tax laws. So that's something to keep in mind as well. You should not wait until you get audited or anything like that to get started on this, because you may enter into a transaction with another party who requires diligence or representations that you're in compliance with local tax laws, and that will hold up any types of transactions that you're doing. So yeah, my recommendation is, if you don't have something like this set up, get started as soon as possible. Book a call with us and we can help you set this up. Next slide.
Daniel, I'm actually curious. Have you seen deals getting held up because of something like this before?
Yeah, I mean, that's why I wanted to add that. Deal get held up for all sorts of diligence purposes. It could be for sales taxes, unpaid sales taxes, or unpaid just taxes on your corporate profits. Those are very common, and companies are very familiar with that, so they always make sure to be in compliance with that. Transfer pricing, people are less focused on sometimes, and they kind of ignore it, and then they get to a point where they want to close a transaction, and one of the lawyers discovers this during diligence, and then it's a mad sprint to get this across the line.
Interesting. All right, let's go to the next slide.
Yeah, so we're going to do another poll here. True or false, transfer pricing documentation is only required if a tax authority audits you. I kind of gave away the answer to this in my previous slide, but it's a good check to see if folks are paying attention, I guess.
Awesome.
So it looks like folks were paying attention, because
it's
100% is false. Yeah, so as I said before, you should not wait for an audit, because if you wait for an audit to do this, then you will owe substantial penalties to local tax authorities. So you should get this done ideally before the first transaction occurs.
Yep. Awesome. Okay, moving on to transfer pricing methods. So I briefly touched upon how there are different types of agreements for different types of functions that can happen between two entities. Now, two of these methods cover 95% of all the services and distribution work that happens between entities. And so we would like to go deeper into those. Again, if your company does something which isn't covered here, like a royalty or loan agreements that we spoke about, again, we'd be happy to talk to you separately. But yeah, for this webinar, we're touching upon cost plus and TNMM methods, right? So cost plus is for service agreements where you're giving a software service or a support service or a KPO, something like that as an offering. And like the name suggests, it is cost plus a certain percentage that you need to send from one entity to the other, right? And we have examples of this in the next slide, so I'll properly explain that. And then the other method is TNMM, which is the net margin method, right? And this is for distribution agreements, right? So in the first case, what you'll see is there is a parent entity doing something, and then a smaller subsidiary, which is providing software services, let's say, and the parent entity has to pay them, right? So they hold the money, so they're sending cost plus some amount to the subsidiary. And in the net margin method, this is for entities that distribute on your behalf in a country, let's say. So they are getting the money in the first place, right? The subsidiary is getting the money in the first place, and they need to send it back to the parent after they retain a net margin, right? So for distribution, for sales, for even in some cases warehousing, TNMM is the method to go for. And in most cases for software services and support services, cost plus is the right one to go for. Can you go to the next slide? So quick example, right? And we've taken Commenda's example here because we are a cross-border business. We have entities in 4 or 5 countries around the world, and this is very important for us. So let's say Commenda US, the parent company, contracts Commenda India, which is the subsidiary, for software development services, right? So you see that Commenda India provides Commenda US with the software development services, and in return, Commenda US pays Commenda India, right? And now to do this, let's say the Indian private limited entity's cost to develop the software was $100,000. We set out in the intercompany agreement that the markup should be 20% based on what? The benchmarking study, right? So we set it at 20%. And then the total amount that Commenda US has to pay Commenda India now is $120,000. And Daniel spoke about this in the beginning. The main reason for countries to mandate this is to tax them, right? So this 20% that the Indian subsidiary gets is entirely their profits, right? And this is the money on which the Indian government will tax Commenda India, right? And Commenda US, of course, based on whatever profits they made in the US, will be taxed accordingly. I hope that's clear. If you have any questions, please drop them in the chat. Next slide. Right. And in the second method, we will swap the places. And so the Commenda US entity now is the subsidiary who is a distributor, right? So the main business is done by Commenda India, and Commenda US is the one selling these services globally or in the US on behalf of Commenda India, right? So all the money from all our customers come in to Commenda US, and then they have to send that money back to the parent entity because they did all the real work, right? And now, before they do that, they will hold a margin, which is 3%, again, decided by the benchmark study and properly documented in the intercompany agreement. So they'll retain the 3% margin and send the rest of the money back to Commenda India. And then this 3% that is retained in the US is the US entity's profit on which they will be taxed. And Commenda India, again, based on their profits for the fiscal year in India, they'll be taxed on that. Can we go to the next slide? Awesome. This is my favorite section, right? So a lot of questions come in asking, hey, how do we decide who is the distributor, who is the service provider, who is doing what, right? And who holds more money, right, in the first place? And the usual misconception is that it depends on whoever is the parent entity or the principal. But what if you're sister entities, right? What if you just have a common UBO? You need transfer pricing in those cases as well. And this percentage of money or the split between how much money each entity makes is completely determined by a FAR analysis, right? FAR, these are the magic letters, guys. Just remember this, and you don't need to know anything else about transfer pricing. So FAR stand for functions, assets, and risks, right? And functions are basically the functions that their entity performs, assets that they hold, and the risks that they bear, right? And the more of each that you do in an entity will help you keep more money there, right? So with the same exact arrangement between two entities in the same geographies, if we see that one subsidiary takes more risks, I'll come back to Daniel's example, right? You have a Canadian entity, you have people who sell in the US for you. If, let's say, the US entity is responsible for the refunds, right, in the US, then that's a risk that your subsidiary is taking. So the percentage that they retain in the US goes up, right? If they perform more functions except for just sales, right? Like, for example, development, training, something like that, markup goes up again. If they hold an IP or any other assets, markup goes up again, right? So functions, assets, and risks together is what we call substance in the transfer pricing terminology. And this substance dictates the flow and retention of money between the two entities. That's the golden rule. You just need to remember that.
Shrey, I think we had a question in the chat.
Yeah.
I'll ping this one over to you.
Yeah. So I'll read that. Why don't we move on until then, Daniel, and I'll come back to that.
All right. Yeah, we'll just run a quick poll. So what's the hardest part of transfer pricing for you right now? Is it setting the right price between our entities, drafting intercompany agreements, creating required documents like the local file, master file, etc., staying compliant with rules in each country, or 5, you just haven't started yet, you don't know where to start?
Meanwhile, I'll just answer Sushma's question here. So Sushma has asked, there are two companies, Canadian and UK, both owned by a common parent in Australia. And can the transfer pricing between North American entities be taken into account for customs purposes as well? Absolutely, Sushma. Customs tariffs are also not the same as transfer pricing, but they're closely related and they both work on comparables, right? Like we have benchmark studies for transfer pricing. You would do a similar process for stuff like customs as well, right? And these are more regulated by the government than transfer pricing. Transfer pricing completely depend on pure benchmarking, right? So yeah, if your transactions are at arm's length and they're well demonstrated, well documented, you can definitely use that for custom purposes as well. I hope that answers
Looking
your
at
question.
Yeah, and like looking at the results of the poll, it looks like setting the right price is the most popular one. Yeah, I mean, that's honestly the hardest thing for companies because they have to run these benchmark studies and sometimes they don't know like, oh, what are the comparables that other companies that are similarly situated with me are paying for these services, et cetera. So that's always the biggest issue we see as well. And we can help you set these benchmark rates and put them into your docs and prepare these files for you. And that will obviously allow you to stay compliant with the rules in each country. Yeah, and then you obviously, thanks for the question, Susma. You know, who does the benchmarking study? That's a great question, Narini. So we basically handle it for you. So it's handled through our software. So like, well, you'll provide our software with like the information we need, which is the type of company, your size, the services that the entities are providing to each other, et cetera. And we generate that benchmark study for you. And we also generate the documentation with those benchmark rates. So all you have to do is just sign the documents and keep those files internally. That's you just provide us the basic information we need, and we run everything else. And if you go ahead, Shrey.
Yeah, one quick thing I wanted to mention. We've seen this with our customers for years as well, right? Setting price is the most difficult part, the benchmarking bit. And so we've worked to develop our software in a way that it takes lesser time to do. So on an average, it usually requires a month or two to do this benchmark study. But at Commenda, we can do it within a few days for a smaller benchmark study and at max in a week, even for like bigger entities. And we run this against thousands of companies in your geography. You take these numbers from a big data set like Bloomberg or Moody's, and then we run an analysis on them basically.
Yeah, and Narini, if you want to see how the software works in action, I've shared a link so you can schedule a call with us and we'll run you through exactly how our software would work for you, for your company. Just book a call with us, free of charge, obviously, and we can walk you through how all that works with our software. So yeah, a couple of country examples here that we can run through. We always like to give kind of concrete examples. I think, at least in our experience, if you're just kind of talking about this in a hand wave or general way, you know, folks can get lost, but giving like really specific examples of how this works on a jurisdiction by jurisdiction basis always helps. So compliance varies by country. So in certain countries, you're going to have to file intercompany agreements or local files. It really just depends on what documentations you need to file. Other countries, it's just you have to have this stuff internally, and so you can make sure that you're ready for an audit if a tax authority audits you. So for the UK and the EU, you need to maintain a local and file and master file for large groups and you need to file it, and also produce it within 30 to 60 days if you get a tax authority request. The United States, Form 5471 is for U.S. persons with foreign subsidiaries. The TP documentation must exist by the time you file your federal return. So as I said before, like it's always good to just do it before your first transaction. But for the United States, at least, absolute worst case, you need to have all of this ready before you file a federal return. And then in India, there's a specific filing called Form 3CEB, which is required if related party transactions meet a certain like revenue benchmark. In this case, it's 1 core in India. And then it's also filed, all this stuff is filed with your return, typically by the 31st of October. You also have to file your local file if certain thresholds are met as well.
And then I'd quickly like to touch upon Canada as well, because we have a lot of folks from Canada.
Right. Yeah.
In Canada, we have a filing called T106, which again goes along with your T2 corporate income tax return filing. And you have to submit the documentation that you've prepared for transfer pricing there. And in the UK, again, like there is no specific requirement until an authority asks you. This varies according to countries, right? So that's why we promote you to, like just get on a call and like we can tell you exactly what you would require for your entities.
Okay. Next slide. So transfer pricing risks, which is what everyone's concerned about here, I'm sure. So as I said before, a lot of businesses don't think about this or sometimes aren't even aware of this. Here are the kind of key risks and penalties to consider. The first are tax adjustments and penalties. So let's say you get audited by an authority and they look at, you may not have documentation. So if you don't have documentation, the authorities would then reprice all those transactions, so it could basically, it would basically be what Shrey called the true up, but now it's like you have to reprice all those transactions so that it actually they would have complied with transfer pricing rules in that jurisdiction and they're appropriately benchmarked. So that can result in a lot of fees that you're going to have to shuffle between your entities. And also, on top of repricing all those different transactions between your entities and subsidiaries, they will also levy a penalty because you did not do so. You know, the second thing is audits and scrutiny, which will lead to tax adjustments and penalties. You know, if you miss certain documentation, it can, trigger all these penalties and price readjustments. But also, you're going to have to go through a bigger, audit process with the local tax authorities, which means you're probably going to have to pay certain vendors to go through this process for you. It's going to consume time for your internal teams as well. And if you had all the transfer pricing documentation set up correctly before the audit, it'd be a really streamlined process. You provide documentation, the government authority's like, oh, we're good, and that's it. If you didn't have that documentation in place or documentation was wrong, it can create a huge audit risk. The audit can go on for months on end, and it can be extremely disruptive to your business operations. The third thing is what I had mentioned before is investor red flags, either if an investor is investing in your company or you're getting bought by another company. Basically, weak transfer pricing governance will definitely be flagged during legal and tax diligence, and it's going to delay entrance into a transaction until you clean that up. So it might delay, a transaction that you really need closed by a couple of weeks or even months. So always good to have this stuff in place, even just for audits, but also regardless if you don't get audited, if you enter into any sort of important transaction, it's going to come up in diligence and you're also going to need to have it regardless if you've been audited or not. And as I said before, all of this stuff, if you haven't prepared it, will be extremely costly to retroactively fix. You're going to hire certain advisors to retroactively fix your documentation, et cetera. So, and we've seen this firsthand for customers who are now entering an M&A transaction and they suddenly book a call with us and it's like, hey, we need to get this done ASAP because we didn't have it before. And you don't want to be in that situation. You want to be in a situation where you're prepared and audit ready and diligence ready. Next slide. So this is a kind of slide outlining the best practices for your transfer pricing governance. So the common pitfalls businesses face, I've covered the first one here, which is delayed compliance. You might have to, you might be in a jurisdiction, one of your entities might be in a jurisdiction which requires filing of all this documentation, and you only figure it out 2 weeks before you need to make the filing, and then it's like a scramble to figure this all out. You're also exposed from an audit perspective, and anytime you might get randomly audited by a government authority, and the penalties might be huge. And this leads into 2 and 3 here, which is missing documentation and misaligned pricing. That can really expose you if you get audited or you go through a diligence process. An example here, a U.S. company didn't benchmark payments to its offshore Indian entity, and it faced a $150K adjustment and really just had 2 weeks to compile the docs. That's the experience we had with a customer that came to us to fix all of this. The best practices to stay compliant are, start as soon as you can, start early, set up your intercompany agreement, set up your benchmarking studies, your local files, your master files, et cetera, which we basically can do all for you. You just have to provide us with the information that we need. And then the only thing you need to do is just sign the agreements and save all the documentation so that it's ready to provide to auditors or anyone who's undergoing diligence on your company. Benchmark annually using reliable comparables. So you should usually be running benchmarks on an annual basis to see if comparables have shifted, which our software can handle for you. And then automate reports and link to your ERP or accounting system. And what this basically means is that, you have to make sure once you have all these policies and agreements in place that the payments you're actually sending, that are documented in your ERP provider software are actually fulfilling these rates and are actually, benchmarked to these rates. So here's another example here. A seed stage startup, SaaS startup used Commenda to set up this TP policy, generate all its documentation, including the company agreement and the local file, and finish benchmarking in a week. So we can do this extremely fast for you and help you set up everything you need to make sure you're compliant. Next slide. So that kind of concludes our presentation here. I'm going to kind of talk about Commenda a little bit, obviously, at the beginning of this call. Hopefully, you guys got a ton of value out of this, and we'll run a Q&A session after I go through the slide. But basically, we help you with all the transfer documentation, transfer pricing documentation, your benchmarking, et cetera. But that's not the only thing we do. The service we basically provide is a managed entity service for all your entities. So we help you incorporate and stay compliant, all these different jurisdictions that you may want to operate in are already operating. And that includes the initial incorporation. After you initially incorporate, you may have to appoint a resident director based on that local country's requirements. You may have to do annual compliance filings that are not related to transfer pricing, but just because you have an entity in that jurisdiction. You may also have to comply with sales tax, VAT, et cetera, and direct tax requirements. And we have a tax engine that handles all of that for you. For all these different entities and all these different jurisdictions, you're going to have to do tax and accounting. So tax filings in the US or in Canada or in other jurisdictions, and also maintain your books. We can handle all of that for you as well. Again, as I said before, we have on-demand legal, tax, and compliance experts. Yeah, Narini, and I'll get to the CPD certificate in a moment here as well. So that's basically all that Commenda offers. We basically help you set up entities and make sure those entities are compliant in every way that they need to be compliant in all the different jurisdictions. And Narini, we're running a poll now. If you answer yes to your CPD credit, there will be someone. If you answer yes to the poll, there will be someone reaching out to get you your CPD credit, your certificate of completion. So just answer yes, and we'll send you it as well. So yeah, that's basically our solution. Yeah, and then we'll also share the slides as well. There'll be someone following up with you with the CPD certificate, as well as a recording of this presentation, so you can reference it back. Yeah, so then if you want to see how our solution works, how we can incorporate all entities for you, how we can make sure these entities are compliant, not just with transfer pricing, but with local accounting rules, local tax rules, local governance rules, and all these different jurisdictions that we support. Book a call with us. I'll share the link as well. We shared it again. But hopefully everyone got value out of this, and you're eager to learn more and eager to see how we can help you guys with this. So you guys don't even have to think about it, and just sign the docs, and everything else will be handled by Commenda. So yeah, these are kind of the key takeaways here. Transfer pricing is a must-have, not a nice-to-have. Start documentation early and revisit annually, which can all be handled through our software. Use automation to cut costs and reduce risks. Again, our software is highly automated, and it's also in coordination of experts on transfer pricing, incorporation, et cetera, on these jurisdictions, which we can handle for you. And a strong TP policy builds trust during investor diligence and also with regulators. Yeah, so now we'll open it up for questions. Happy to answer anything we have. If you have a lot of specific questions about your company, your situation, best thing there is to book a call with us. We can walk you through everything you needed to do, not just for transfer pricing, but for other types of tax filings, for other types of incorporation filings, compliance filings, et cetera.
Yep, and Sushma asked if this is valid for customs as well. Sushma, we also help with things like customs and tariffs. So again, if you just want to dive deeper into that topic, we have experts who can help you with customs and tariffs as well. So please go ahead and book a call.
So we'll keep it open for a couple minutes here. See if you have any questions. Just feel free to drop them in the chat and we'll answer them. We'll keep the session open for a couple minutes. But yeah, thank you everyone for joining again, and book a call with us if you thought this was really valuable and you want to get started.
And one more quick thing I want to mention, since I saw a lot of you have a good understanding of transfer pricing already, right? A key headache that comes in later is the true ups that we spoke about, right? Just making sure that your accounting is also in line with transfer pricing. And we saw this problem with a lot of our customers as well. So we've recently launched what we call operational transfer pricing, where we sync in directly with your ERP, and we support like dozens of ERPs, right? QuickBooks, Xero, Puzzle, Sage Intact, Microsoft Dynamics, all of them. And we would pull in your numbers directly from your ERP, check for all intercompany transactions, see if you're compliant with the policy or not. And if not, we'll tell you that, hey, this is the true up that you need to do. I'm really excited about that one. So yeah, if you just want to watch it in action, we'd be happy to show you at any point in time.
Yeah, folks, and as I said before, we welcome questions. Feel free to push us. Any hard questions you have, happy to answer them on here or schedule a call with us. And you can talk to one of our sales reps. Also, we've gotten this request too. If you want Shrey or me to join that call as well, we can join that. So yeah, anything we can do to help your business. I'll give it another minute for questions, and if not, we'll close this shortly. Thank you, Diksha. Appreciate it. Thanks, everyone. I'm glad a lot of people found a lot of value from this. That's mainly
Yep.
our goal. I know this is complicated, and a lot of folks, you have to really build trust before someone really chooses to go with you as a vendor. That's the goal of this. Thanks, Nirani. Appreciate it. Thank you, Sahid. All right, I'll give it 30 more seconds for questions. And after that, we'll drop off.
Yep.
Thank you, everyone. All right.
All right, guys.
See you guys. Feel free to
Thanks
reach
for
out to us with any
joining.
questions, book a call. See ya.
Yep.